Welcome to the Explainer. Okay, I want you to start by just visualizing something with me for a second. Imagine taking a crisp $100 bill way back in 2010. You invest it, you tuck it away, and you just wait. You let the years roll by. And then, years later, you log into your account and you watch as that initial tiny $100 investment has literally exploded into 1,000, then 10,000, and eventually well over $1 million. I mean, it sounds absolutely impossible, right? No way. But that is exactly what happened to some of the earliest investors in Bitcoin. It's like a modern-day gold rush. But, and this is a massive, massive but, millions of other people lost huge amounts of money chasing those exact same quick profits. Okay, let's dive into this. On one hand, we have this incredible promise, the future of finance, a revolutionary technology, what some even call digital gold. But on the other side, the stark reality for many is a financial gamble, volatile, speculative, and incredibly risky. So which one is it really? Well, over the next few minutes, we're going to uncover the truth, completely impartially. We'll look at the mechanics, the history, and the very real risks, giving you a complete picture of this whole shebang. Section 1. What is cryptocurrency? The mechanics of digital assets. So, unlike the traditional cash in your physical wallet, cryptocurrency isn't issued by a central bank or a government. Instead, it operates across these entirely decentralized computer networks, using cryptography to secure transactions. And this brilliantly illustrates the core technology making it all possible: the blockchain. You really have to think of the blockchain not as a physical coin, but as a giant digital ledger, where every single transaction is recorded in chronological order. Once a transaction is logged in there, it is extremely difficult to alter or tamper with. And because this ledger is distributed across a massive network, the system dramatically improves both transparency and security for all of us. Section 2. The birth of Bitcoin. The origins of decentralized money. To truly understand this global movement, we kind of have to go back in time to a singular, incredibly ambitious goal: creating a digital payment system that simply didn't rely on banks at all. Back in 2008, an unknown person, or maybe a group of people, we still don't know for sure, using the pseudonym Satoshi Nakamoto, published the famous Bitcoin paper. This outlined an entirely new financial concept. By January 2009, the network officially launched. Now, initially, very few people paid any attention, and early users were treating Bitcoin for literal fractions of a cent. Somebody famously bought 2 pizzas for 10,000 Bitcoin. But over time, as global awareness grew and the network proved its resilience, well, we arrived at the present day, where Bitcoin has become one of the most valuable assets in the entire world. Section 3. The major digital assets beyond Bitcoin. Now, while Bitcoin started it all, today there are thousands of cryptocurrencies out there, and they are absolutely not all designed with the same purpose in mind. To really understand the crypto space today, we've got to categorize the major players. Now, what's really interesting about this slide is how different they all are. Bitcoin is primarily viewed now as a store of value. Ethereum, however, was actually built to enable smart contracts and decentralized applications. Look at Solana. Its primary architecture is designed specifically for incredibly fast transaction processing. Then there's XRP, which is focused on facilitating specific types of cross-border payments. And finally, we have stablecoins. These serve a completely different function. They're designed specifically to track the value of traditional currencies, like the US dollar, to offer stability in a highly volatile market. So as you can see, every single one serves a unique function in this digital ecosystem. Section 4. High rewards, extreme risks, the danger zone of investing. It's absolutely crucial we shift our perspective here. Why do people actually invest in crypto? And what are the real dangers? Look, while people are naturally drawn to the space seeking portfolio diversification and long-term price appreciation, we have to acknowledge a fundamental rule of finance. Higher potential returns inherently mean higher risks. People invest because they believe in the blockchain technology, or maybe they just want to use it for online transactions. But the terrifying reality is that prices can fall just as rapidly and dramatically as they rise. These dangers aren't just theoretical, they are systemic to the current environment. You need to be acutely aware of the inherent market risks. We're talking extreme market volatility and constant cybersecurity threats. But honestly, perhaps the most jarring risk of all is the loss of private keys. Think about it. In traditional banking, if you forget your password, you just click a button to reset it, right? In crypto, a lost password or a misplaced recovery phrase can mean a total, unrecoverable loss of your entire investment. Gone, just like that. Plus, on top of all that, you face changing government regulations globally alongside ongoing technology risks. And unfortunately, the risks aren't just from the market itself, they're from bad actors. You've got to keep your eyes peeled for these warning signs of crypto scams. If anyone, anywhere, promises you guaranteed profits, run. Just run. Watch out for celebrity impersonation scams, fake investment websites designed to look exactly like the real thing, traditional Ponzi schemes that have been adapted for the digital age, pump and dump groups on social media, and fake giveaways. I really want to remind you of the oldest rule in the book here. If an investment opportunity sounds too good to be true, it almost always is. Section 5. The 5 Golden Rules. How to approach crypto investing safely. Okay, let's take a breath. Financial professionals suggest you should really only consider crypto after you've built an emergency fund, paid off high-interest debt, and invested in diversified, long-term assets. But if you've done all that, and you decide cryptocurrency fits your personal risk tolerance, you are going to need a survival guide. So, the crucial point is to follow these 5 actionable rules. Number 1, invest only what you can afford to lose. Risk management is essential here. Start small. Number 2, do your own research before buying. Please, don't just invest based on social media hype. Number 3, think long-term and avoid emotional buying and selling. Number 4, protect your digital assets with strong security. Use reputable exchanges, enable 2-factor authentication, and guard your recovery info with your life. And number 5, never ever believe promises of guaranteed returns. Cryptocurrency has undeniably changed the financial world. It's introduced entirely new technologies and investment opportunities. But successful investing is never about chasing excitement. It's about understanding risk, staying disciplined, and making informed decisions. Whether cryptocurrency becomes the bedrock of the global financial system or just remains one asset class among many, I want to leave you with this final empowering thought. Knowledge is your greatest investment. So what about you? Will you take the time to truly educate yourself before placing your bets in the digital gold rush?